Welcome back to the deep dive. We're here again to cut through the noise, the jargon, and really get to the heart of financial knowledge that actually matters.
That's the goal.
And today, we're tackling something fascinating, something that's really puzzled investors and researchers for ages: the stock market. Specifically, those strange, predictable patterns you sometimes hear about.
The anomalies, yeah.
Exactly, the anomalies. It's like trying to find a hidden current in this vast, seemingly random ocean of stock prices. People have been building models for years trying to crack that code.
Oh, absolutely. And, there have been some huge successes along the way. I mean, think about the Fama-French three-factor model.
Oh.
For a long, long time, that was the lens, the clearest way we had to understand why some stocks move differently than others.
A real pillar of finance.
Totally foundational. But, well, market doesn't sit still, does it? It changes, it adapts,
Yeah.
it throws new curveballs.
Mhm.
And over the last, say, 2 decades, we've seen something like 80 distinct anomalies pop up.
80, wow.
Yeah, patterns that the old models, even Fama-French, just couldn't quite explain. It's like the market started, I don't know, learning new dance steps, and our old instructions didn't work anymore.
And that's precisely where we're diving in today. We're going beyond that old playbook. We're looking at a really groundbreaking new empirical model. It's called the Q-factor model. And this isn't just, tweaking the old stuff. It's a fresh framework built really to digest these tricky anomalies, to make sense of what looked like market chaos.
That's the aim.
So we're going to unpack what this model actually is, dig into the economic thinking behind it, and then show you how it stacks up against the classic models.
Yeah.
And honestly, the results are pretty surprising. They tell us a lot about what really drives stock returns.
Yeah, think of this as your fast track, maybe. A shortcut to understanding what's happening right at the cutting edge of asset pricing research without needing a PhD to follow along. You're going to see how basic economic ideas, things like investment and profitability, aren't just accounting terms. They're actually like the main characters in this whole market drama.
Moments, that's what we're after, without the dense academic speak.
Exactly. We'll get you those insights.
Okay, let's do this. To really get why this Q-factor model is such a big deal, we need to understand the problem it was built to solve. So let's step back a bit. Why did those traditional models, especially Fama-French, start to, well, miss the mark?
Yeah, good place to start. Back in the mid-90s, Fama and French, it wasn't just influential, it was like world-changing for finance.
Absolutely.
Their model basically said, look, a stock's expected return comes down to how sensitive it is to 3 things, 3 main factors.
Okay, what were they?
First, the obvious one, overall market risk. They called it MKT, just, the general market going up and down.
Standard.
Second, the size factor, SMB, small minus big. This captured that tendency that we'd seen for smaller company stocks to, on average, do better than large company stocks.
Right, the size premium.
And third, the value factor, HML high minus low. This explained why stocks with high book-to-market ratios, the value stocks, tended to outperform stocks with low book-to-market, the growth stocks.
The value premium.
Exactly. And for its time, it was incredibly elegant. It summarized so much of what people saw in average stock returns.
It really became the bedrock, didn't it? For academics, for practitioners, everyone used it. But even then, there was that one nagging thing it didn't quite capture.
Momentum, yeah.
Yeah.
That was always the big exception, even from the early days. And then, like you said, the market just kept evolving.
Kept throwing those curveballs.
It really did. Over the next couple of decades, the financial world didn't just change a little. It kind of exploded with new puzzles, these anomalies. And the Fama-French model, for all its initial power, just couldn't keep up.
It wasn't just 1 or 2 things, right? Give us a sense of the scale here.
Oh, no, it was a whole collection. Think about the post-earnings announcement drift. A company reports surprisingly good earnings, and the stock doesn't just jump once. It keeps drifting up for months. That flies in the face of pure efficiency, right?
Right.
That was noticed way back, but really nailed down later. Then you had all the stuff around companies issuing stock IPOs, seasoned equity offerings. Research showed these companies often underperformed significantly afterward.
Shearer's underperforming, yeah.
And of course, price momentum itself, really solidified by Jagadish and Tipman. Winners keep winning, losers keep losing over that medium term. And then Sloan pointed out the accruals anomaly firms with high non-cash earnings tended to do worse later on.
So a growing list of things the three-factor model just couldn't explain.
Exactly. It started to feel like the model was missing some fundamental pieces of the puzzle.
Which must have created this sense of urgency in the academic world. Like, okay, we need something better.
Absolutely. John Cochrane, who's a giant in the field, he put it really clearly back in 2011. He basically said, look, we need to redo what Fama and French did. But for all these new anomalies, he asked the right questions. Which characteristics actually give us independent information? Do all these anomalies mean we need brand new factors? How many factors do we really need for a simple, powerful model?
Setting the stage perfectly for a new approach.
Precisely. That was the challenge the Q-factor model set out to meet.
Okay, the main event then. Let's bring in the Q-factor model. What is it fundamentally? What's the big idea here?
Okay, so the Q-factor model, it's an empirical model developed by Qiwei Hu, Chen Xu, and Lu Zhang. And the core idea really is to build a new framework that can basically summarize the whole cross-section of average stock returns.
The whole thing. Ambitious.
Very ambitious.
Yeah.
And specifically designed to capture many, maybe not every single one, but many of those really stubborn anomalies that tripped up the Fama French model. It's trying to bring order back to that seemingly chaotic picture.
And crucially, it's not just statistics, right? It's grounded in some economic theory.
That's a key point. Yeah, it's not just data mining. It's deeply inspired by what's called investment-based asset pricing, which itself comes from the neoclassical Q theory of investment.
Q theory.
So it's rooted in how firms actually make decisions about investing capital. That gives it a really solid economic foundation that's not just correlation hunting.
That's important. Okay, so Fama French had 3 factors. Q factor has 4. Let's break them down.
Right. 4 factors explain the expected return above the risk-free rate. First one's familiar, market excess return, MKT, overall market risk.
Got it.
Second, the size factor, RME. Very much like Fama French's SMB, captures that return difference between small stocks and big stocks.
Okay, still familiar ground. Now for the new ones, these are the anomaly busters.
These are the key innovations, yes. Factor 3 is the investment factor, RIA. This looked at the return difference between stocks of companies that invest less versus those that invest more. The idea is low investment predicts higher returns.
It's interesting. Low investment, higher returns. Okay, and the fourth?
The fourth is the profitability factor, RRE. This captures the return difference between stocks with high profitability, specifically measured by return on equity, ROE, and stocks with low profitability.
Investment and profitability. Those are the 2 big new engines.
They're the intellectual core of the model, absolutely.
So just high level for a second. What's the intuition? Why investment? Why profitability? Why are these the keys?
Well, the basic idea, and we'll definitely dig into this more, is that a company's decision to invest isn't just random. It's a direct response to how profitable it expects to be and what its cost of capital is.
Okay.
Think about it. Firms invest when they see good opportunities. But if a company has high expected profits but it's not investing much, what does that tell you? It probably means its cost of capital, the hurdle rate for new projects, must be pretty high.
Ah, okay. High hurdle rate stops them investing even if profits look good.
Exactly. And conversely, if a firm is investing a ton, that suggests its cost of capital is relatively low. These 2 things, investment and profitability, are tangled up in a company's core decisions, and that has direct implications for the expected return on its stock. For you, the listener, it means these aren't just numbers on a page. They're signals.
Powerful signals about future returns. Okay, that makes sense. But how do they actually build these factors? It sounds complicated.
It's a pretty sophisticated process, yeah.
Yeah.
They use what's called a triple 2x3x3 sort. Imagine sorting all the stocks. First, they split them into 2 groups based on size, small and big.
Okay.
Then, within each size group, they sort the stocks independently based on their investment to assets, or IA, into 3 groups: low, middle, high investment.
Right.
And then, again, independently within each of those groups, they sort by ROE into 3 more groups:
Yeah.
low, middle, high profitability.
Wow, okay. So you end up with 18 different buckets of stocks, 2 times 3 times 3.
Exactly. 18 distinct portfolios. It's a detailed grid.
And why is controlling for size in there so important?
Because the evidence shows that both the investment effect and the profitability effect are just much stronger in small companies than in big ones. So by controlling for size, while constructing the other 2 factors, they make sure those factors capture the effects across the whole market, not just dominated by tiny stocks.
Avoid skewing the results.
Right. And sorting on investment and ROE independently also helps what they call orthogonalize the factors. Basically, making sure the investment factor is really measuring investment, and the ROE factor is really measuring ROE, not accidentally picking up bits of each other.
So they capture distinct information, makes them cleaner, more powerful.
Yes, precisely.
So this elaborate construction, does it work? Empirically, what do these factors look like? Do they actually deliver?
They really do. The numbers are quite impressive. Looking at the data from 72 to 2012, The size factor, RME, averaged about 0.31% per month. Respectable.
Okay.
But the new ones are the stars. The investment factor, RIA, averaged 0.45% per month. And the ROE factor, ROE, was even higher at 0.58% per month.
Those are pretty significant premiums.
And statistically very significant, too. The T-stats were nearly 5 for both. That easily clears the high bar you need for demonstrating new factors. These aren't just random noise. They're robust.
Very robust. Okay, critical question. How do these new guys, investment and ROE, relate to the old guard? Like Fama French's HML, the value factor, or Carhart's UMD, the momentum factor? Are they just repackaging the same thing?
This is where it gets really interesting and leads to a pretty major reinterpretation, actually. So the investment factor, RIA, it turns out, is highly correlated with HML, correlation of 0.69.
Okay, strong link there.
And the ROE factor, ROE, is significantly correlated with momentum, UMD, correlation of 0.50.
Also related, so.
But here's the twist, the aha moment. If you take HML and UMD and test them inside the Q-factor model, their alphas, the leftover return the model can't explain, become small and statistically insignificant.
So the Q-factors basically explain HML and UMD?
Largely, yes.
Yeah.
But now, try it the other way around. Try to explain the investment and ROE factors using the older Carhart model, which includes HML and UMD. What happens?
Let me guess. It doesn't work so well.
Exactly. The alphas for the investment and ROE factors remain large and highly significant within the Carhart model.
Wow. So, wait. Q factors explain value and momentum, but value and momentum don't explain the Q factors. That basically implies HML and UMD might just be, like, less precise versions of these deeper investment and profitability effects.
That's precisely the interpretation the evidence points to. HML and UMD might be noisy versions of the more fundamental investment and ROE factors. The Q factors seem more refined, more directly tied to the underlying economics, and empirically more powerful.
That's a huge shift in perspective. Okay, couple of quick methodology points. This whole thing is designed for the broad market, right? Not just those tiny illiquid stocks.
Absolutely. A critical point, yes. It's explicitly designed for the broad cross-section, using standard things like NYSE breakpoints for size sorts and value-weighted returns. This avoids the microcap problem, where you find weird results in tiny stocks that nobody can actually trade cost-effectively.
Good. Making it relevant for real-world investors. And that joint sorting on investment and ROE, you said it's because the effects are conditional. Can you elaborate just a bit more on that?
Yeah, it comes straight from the underlying economic theory, equation 4 in their paper. It shows these effects depend on each other, like the negative link between investment and expected returns.
Yeah.
That really only holds true given a certain level of ROE.
Ah, okay.
If you just look at investment alone, a high investment firm might also have super high ROE, and the relationship could get muddied. By sorting on both simultaneously, you're controlling for these interactions, isolating the true conditional impact of each factor, much cleaner.
Isolating the true effect. Got it. And the rebalancing annual for investment, monthly for ROE. Why the split?
It matches the typical information flow and how those anomalies are usually constructed. Investment decisions, asset growth, accruals, that stuff relies on annual accounting data. So the investment factor rebalances annually. But profitability, momentum, earnings, surprises, those are driven by more frequent news. Earnings come out quarterly, prices move constantly. So the ROE factor uses the latest available ROE data and rebalances monthly to capture that faster-moving information.
Aligning the factor construction with the nature of the anomalies themselves. Smart.
Exactly. It's all very deliberately designed.
Okay, fantastic groundwork. We know what it is, how it's built. Now let's get into the economic soul of this thing. Why? Why investment? Why profitability? Let's start with that investment channel.
Right. The core prediction, simply put, hold everything else constant. High investment stocks should earn lower expected returns than low investment stocks.
Feels a bit backwards at first. High investment sounds good, right? Growth.
It does, but think about it from the firm's point of view, based on that Q theory. Firms invest more when their marginal Q is high, basically, when the expected payoff from new projects looks really good relative to the cost.
Okay, high potential payoff drives investment.
Yes, but what determines that payoff assessment? The cost of capital is key. If a firm has a low cost of capital, its discount rate is low. So future cash flows look more valuable today, marginal Q is high, and they invest more.
Low cost of capital, high investment.
Exactly. Conversely, if the cost of capital is high, those same future cash flows get discounted more heavily, marginal Q is low, projects look less attractive, and they invest less.
High cost of capital, low investment.
Right. So observing a firm investing heavily is actually a signal that its cost of capital is probably low. And if its cost of capital is low, the expected return demanded by investors for holding its stock should also be lower.
Ah, the investment level itself becomes a signal about the required return. That clicks. How does this show up in specific anomalies we know?
Loads of them. Think about equity issues. Firms issuing lots of stock often need to fund big investments. Because they have to invest, they might take projects that, on the margin, aren't quite as high return. The result: these issuers tend to underperform later on. Explains things like NSI and CEI anomalies.
Okay, equity issuance fits. What else?
Asset growth. If you just measure investment as the change in a firm's total assets, you find a very consistent pattern. High asset growth predicts lower future returns. It's a really comprehensive measure of this investment effect.
And the big one, the value premium. Value stocks beating growth stocks. How does investment explain that?
This is one of the most elegant parts. Value firms, high book-to-market, low market-to-book, typically have lower marginal Q. The market isn't valuing their growth options as highly, so following the theory, they could invest less.
Okay, value firms invest less.
And because they invest less, it implies their cost of capital is higher, meaning their expected stock returns should be higher. Growth firms are the opposite. Low book-to-market suggests high marginal Q, they invest more aggressively, implying a lower cost of capital and thus lower expected future returns.
So value isn't just cheap, it's linked to lower investment and higher required returns. That's a powerful reinterpretation.
It really is. It connects valuation directly to fundamental corporate investment policy.
Does it also explain long-term reversal? Where past losers tend to outperform past winners over long horizons?
Yes, it does. Think about those long-term winners. They were likely growth firms, investing heavily due to past success and high marginal Q. The investment channel predicts they should continue to invest and thus earn lower future returns.
Winners say.
And the long-term losers. They've likely scaled back investments significantly, signaling a higher cost of capital. Therefore, they're expected to earn higher future returns. It provides a really coherent economic story for that reversal effect.
Brilliant. Okay, that's the investment channel. Let's switch gears to the profitability channel. What's the core prediction there?
It's kind of the mirror image. The prediction is, all else equal, firms with high expected profitability should earn higher expected returns than firms with low expected profitability.
This one feels more intuitive, maybe.
Yeah.
High profits are good, so higher returns.
It seems that way on the surface, but the nuance comes when you consider it alongside investment, just like before.
Okay. It's about the interaction again.
Exactly. Picture a firm. It expects really high profits.
Yeah.
But it's not investing much. Why would that be?
Because maybe its cost of capital is really high, so even good projects don't clear the hurdle.
Precisely. For the firm not to invest, despite high expected profitability, its discount rate, its cost of capital, must be high enough to offset those attractive profits and make new projects look unattractive.
Low NPV.
So high expected profits plus low investment, high required return, cost of capital.
You got it. And the flip side, low expected profits, but the firm is still investing a lot. That must mean its cost of capital is relatively low, making even less profitable projects seem worthwhile.
Low expected profits plus high investment is low required return. It's about that balance.
It's all about that balance. And you can even connect this to basic valuation, like the Gordon growth model. High expected cash flows relative to a low stock price, which is like high expected profitability relative to low market to book, implies the market is using a high discount rate.
Okay, the theory holds together. What real-world anomalies does this profitability channel illuminate? It's key for several big ones. Momentum, again. Momentum winners tend to be firms with higher recent and expected profitability. The profitability channel explains why they should earn higher expected returns. Positive profit shocks often drive the initial price jump.
Profitability drives momentum. Makes sense.
Also, the post-earnings announcement drift, PAA. Firms that beat earnings expectations are, by definition, more profitable than thought. The channel explains why their stocks keep drifting up as the market digests this positive news about profitability.
PED fits too. Anything else?
Financial distress. Firms that are less financially distressed are generally more profitable. So according to the profitability channel, they should earn higher expected returns than more distressed firms, which struggle with profitability.
So again, these seemingly unrelated phenomena, momentum, PA, distress, all trace back to this fundamental profitability effect.
It provides a remarkably unified and intuitive economic explanation.
Okay, this is fantastic. We have the model, the intuition. Now, the moment of truth. How does the Q factor model actually do? when you throw all those anomalies at it. The paper looked at nearly 80.
Right. Yeah. They really went comprehensive, covered all the major categories: momentum, value growth, investment, profitability, even intangibles, and trading frictions, a huge playing field.
And they were selective within those categories, using the most important variables.
Right. Aiming for conceptual coverage, but empirical parsimony. Using composite measures like composite issuance instead of 5 different issuance variations. This actually makes the test harder for the model, which makes its success more compelling.
And crucially, they focused on the broad market, mitigating that microcap issue.
Absolutely key. Using NYSE breakpoints and value-weighted returns. Remember, microcaps are like 60% of stocks by number, but only 3% by market cap. Anomalies driven by those tiny, illiquid stocks often aren't practically exploitable. This study focuses on results relevant for the actual investable market.
Okay, rigorous setup. So what's the first big takeaway? The headline finding from this massive test.
The first and maybe most surprising finding is this. Out of the 74 primary anomalies they looked at, about half, 38 of them, turned out to be statistically insignificant in the broad cross-section.
Half. Insignificant. So much for the anomaly zoo everyone talks about.
Exactly. It suggests many claims in the literature might be, well, exaggerated, as the paper puts it.
Were there specific areas where this was really obvious?
Oh, yeah. The trading frictions category got hammered. 12 out of 13 anomalies there were insignificant. Things like idiosyncratic volatility, short-term reversal, analyst dispersion, illiquidity. Their average returns just weren't statistically different from zero in the broad market.
So trading frictions, maybe not such a big driver of broad market returns after all.
Seems that way. Based on this evidence, it really downplays that whole category. And there were others too, outside of frictions, things like abnormal corporate investment, total accruals, the F-score, governance index, also insignificant.
Wow. So the exaggeration likely comes from overweighting those microcaps or maybe less stringent tests in earlier studies.
That seems to be the conclusion, yeah. Primarily the microcap issue, it seems.
Okay, finding one. Half the anomalies might not even be real in the broad market. What about the other half, the 35 or so that are significant? How does the Q-factor model do explaining those?
This is where it really shines. For those 35 genuinely significant anomalies, the Q-factor model performed much, much better than Fama French or Carhart.
How much better? Give us the numbers.
Okay, look at the average magnitude of the alphas, the unexplained part of the return. For the Q-factor model, it was just 0.20% per month. Compare that to 0.33% for the Carhart model and 0.55% for the Fama French model.
So Q-factor leaves less than half the unexplained return compared to Fama French. That's huge.
It's a massive improvement. Put another way, out of those 35 significant anomalies, the Q-factor model left only 5 with statistically significant alphas. It explained 30 of them.
Only 5 left unexplained.
Compared to 19 left unexplained by Carhart and 27 left unexplained by Fama French. And it also did better on overall statistical tests like the GRS test, fewer rejections, meaning a better overall fit.
It's not even close then. Did it dominate across the board, or were there specific areas where it was particularly strong?
It was strong generally, but particularly impressive in momentum and profitability. For momentum anomalies, average alpha was way lower, 0.19% for Q-factor versus 0.85% for Fama French. Only 2 significant alphas left versus all 9 for Fama French.
Crushed momentum. What about investment?
Investment category.
Yeah.
Only 1 significant alpha left out of 11. But profitability was the real knockout.
Go on.
For the 5 profitability anomalies, none of the high minus low alphas were significant in the Q-factor model. 0 unexplained. Whereas all 5 were significant for both Carhart and Fama French. The average alpha magnitude was tiny for Q-factor, 0.12% compared to 0.61% for Carhart and 0.95% for Fama French.
Wow. It just completely digested the profitability anomalies. What about value versus growth?
There, the models were more comparable, actually. All 3 did reasonably well, though Q-factor still edged out slightly on some measures.
Okay, incredibly strong performance overall, but you mentioned it's not perfect. Where did it stumble a bit?
Right, there were a couple. The operating accrual anomaly from Sloan back in '96. Q-factor didn't explain that one as well. And the R&D to market anomaly was another tough spot.
The R&D one.
Yeah.
The alpha was still pretty high there.
Yeah, the alpha for the R&D anomaly was still 0.60%, statistically significant, even though the other models actually had slightly lower alphas for that specific one. So, not perfect, but vastly better overall.
Okay. And the size factor. We established the investment and profitability factors are the powerhouses. Does size add much beyond just matching the number of factors in Carhart?
It's a fair question. It is important for fitting the returns across different size groups themselves, like The small minus big return is explained well with the size factor, but not without it.
Okay, so it does that job.
But its incremental impact on explaining those other 35 significant anomalies, pretty limited. If you run the model without the size factor, the average alpha for those anomalies only ticks up slightly, from 0.20% to 0.23%. Still way better than the other models.
So size helps with size itself, but investment and ROE are the real workhorses for explaining the broad range of anomalies.
That's exactly what the evidence suggests.
This is where it all connects. Let's talk about the factor loadings, how the sensitivities of stocks to these factors link back to their actual characteristics. You said anomalies are just different combinations of the investment and ROE effects. Let's see that in action.
Exactly. This maps the model back to the economics. Start with momentum and profitability. The link is primarily to the ROE factor.
So momentum stocks load heavily on the ROE factor.
Precisely. Winners versus losers, the ROE factor loadings are substantial and highly significant, ranging from 0.18 up to 1.48. And this mirrors reality. The actual ROE spreads between winners and losers are large, up to 6.5% per quarter. Momentum winners are more profitable, and they behave like high ROE stocks in the model.
And this even explains momentum reversal.
Yes. For longer holding periods, those momentum reversal portfolios show insignificant returns. And guess what? The Q-factor model produces insignificant alphas for them too. It captures both the momentum effect and its tendency to fade.
Very neat. Okay, what about value versus growth? We link that to investment theory. Do the loadings confirm it?
They do. Value versus growth anomalies are mainly linked to the investment factor. The loadings range from 0.85 to 1.45, all highly significant. And again, it matches the characteristics. Value stocks show higher investment factor loadings, and they do indeed invest less than growth stocks. The model reflects the economics.
Consistent. What about other investment-related anomalies, equity financing, inventory accruals, all investment factor too?
Primarily, yes. The investment factor loadings are strongly negative and significant for these high minus low deciles. And the underlying investment to asset spreads are huge. It's clear evidence that investment policy is a common thread. Net operating assets, NOA, was an exception here, though, with insignificant loadings.
Okay, and profitability and distress anomalies, driven by ROE.
Absolutely. The ROE factor loadings are large and highly significant, mirroring large spreads in actual ROE between, say, high and low profitability firms or less and more distressed firms.
It's really striking how these two factors cover so much ground. What about something complex like organizational capital, intangibles?
Great example of the synergy. The OC effect is captured by both factors working together. High OC firms tend to be more profitable, but invest less in physical assets. The model picks this up perfectly. Positive loading on the investment factor, reflecting lower investment relative to low OC firms, and positive loading on the ROE factor, reflecting higher profitability. The combination explains the return spread.
Showing how the factors interact. Now, back to that tricky R&D to market anomaly. Why did the model struggle there again? What's the mechanism?
It comes down to accounting. High R&D firms actually report lower ROE. Why? Because standard accounting expenses R&D immediately. It doesn't capitalize it as an asset. This artificially depresses reported earnings in ROE.
The accounting gets in the way of the economics.
Exactly. So, because high R&D firms look like low ROE firms on paper, they get a negative loading on the ROE factor. But high R&D firms tend to have positive average returns. The loading goes the wrong way to explain the returns.
So the model fails because the input data, ROE, is distorted by accounting rules for this specific case.
Precisely. The paper suggests that if you adjusted the earnings to capitalize R&D, the model would likely perform much better here.
Fascinating detail. What about volatility, systematic, SUVOL, and idiosyncratic, IVOL?
SUVOL seems largely captured by the ROE factor. High SUVOL stocks tend to have lower ROE and load negatively on the ROE factor. IVOL is trickier. We noted it was often insignificant overall. But interestingly, even for IVOL, the Q-factor model dramatically reduces the alpha compared to other models. And here, both the investment and ROE factors contribute significantly with negative loadings. Shows the model's reach even for complex risk measures.
Okay, this has been incredibly thorough on the model's performance. Let's zoom out slightly again. Methodological insights. The model is reduced form, not structural. Why is that distinction important?
It's about practicality versus theoretical purity, in a way. A full structural model tries to estimate the deep parameters of how firms make decisions, complex stuff. The Q-factor model is inspired by that theory, Q theory, but doesn't try to estimate all those deep parameters directly.
It uses the implications of the theory, but stays closer to the observable data.
Exactly. It's an empirical or reduced form model. The advantage is simplicity and avoiding potential errors you might make specifying those complex, unobservable production technologies in a structural model. It leverages the high-frequency return data we actually have.
More practical, avoids certain types of errors. What's the trade-off?
The main one is that the factor model requires stocks with similar characteristics like investment or ROE to actually move their returns need to move together. The basic economic theory doesn't strictly require that movement. So the empirical model relies on an assumption that the theory itself doesn't guarantee, although the evidence suggests it holds.
Understood. It's a powerful empirical tool, grounded in theory, but with some inherent assumptions. Now, Sharpe ratios, the risk-adjusted return measure. How do the Q factors look?
Individually, they look very strong. The investment factor, RIA, has a monthly Sharpe ratio of 0.24. The ROE factor, if you are what it is at 0.22.
How does that compare to the old factors?
Much better. HML Sharpe ratio is only 0.13 and UMD's is 0.16. So the Q factors themselves are delivering significantly more bang for the buck, risk-wise.
Higher risk-adjusted returns from the factors themselves. What about the overall models? If you combine the factors optimally in each model?
That's where the Q factor model really pulls ahead. The maximum Sharpe ratio you can get from the Fama French model is 0.21. Carhart gets you up to 0.30 by adding momentum, but the Q factor model achieves a maximum Sharpe ratio of 0.43.
Wow, 0.43 compared to 0.30 for Carhart. That's a substantial jump in efficiency.
It really is. It shows that combining these specific factors allows for a much more efficient way to capture risk-adjusted returns compared to the traditional models.
And how do the Sharpe ratios of individual anomaly portfolios look compared to that 0.43?
Generally lower. Some are decent, maybe 0.14 or 0.23 for specific strong anomalies, but usually well below the overall efficiency offered by the combined Q factor model.
Okay, but what if you pooled all those significant anomalies together? Could you create some super portfolio with an insane Sharpe ratio, suggesting massive arbitrage opportunities?
Well, it highlights the potential scale of mispricing if these things weren't explained by a common factor model. If you pool, say, 28 of the significant high minus low deciles, you can get a Sharpe ratio of 0.48. Okay, a bit higher than the Q model itself.
But what if you pool all the deciles across categories?
Then the theoretical maximum Sharpe ratio jumps to 1.6.
1.6. That's astronomical for liquid markets. What does that tell us?
It tells us there would be enormous profit potential if these anomalies were truly independent and unexplained. The fact that the Q factor model, with its own Sharpe ratio of 0.43, can explain most of these individual anomaly returns suggests it's capturing the common variation that prevents these extreme Sharpe ratios from being easily arbitraged away in reality.
So the existence of the Q factors, which have high but not insane Sharpe ratios, implies that these anomaly stocks co-move in ways related to investment and profitability, limiting the diversification benefit.
Exactly. If they didn't co-move, you could diversify away their individual risks and potentially achieve those crazy high Sharpe ratios. The Q factor model's success suggests this co-movement, driven by investment and ROE characteristics, is real and significant.
Okay, final big question then. Does the success of this model mean the market is inefficient, mispricing? Or are these factors just capturing new forms of rational risk? What's the Q factor model's official stance on the big rational versus mispricing debate?
This is crucial. The paper is very clear. The Q factor model is officially silent on that debate.
Silent. It doesn't take a side.
Nope. It presents itself primarily as an empirical model for estimating expected returns and capturing common variation. It shows what patterns exist and links them to investment and profitability characteristics. It doesn't definitively label those patterns as compensation for fundamental risk or as behavioral mispricing.
So it describes the what incredibly well, but stays agnostic on the ultimate why.
Precisely. Which brings us back to that classic argument from McKinley in '95. He argued the Fama French model's Sharpe ratio was already maybe too high for purely rational risk stories alone.
Right, hinting at mispricing.
And the Q factor model, with an even higher Sharpe ratio, 0.43, makes that question even more pointed. It suggests that maybe trading opportunities with mild Sharpe ratios, like those from the Q factors, can persist, even if the truly extreme ones get arbitraged away. It's a fantastic empirical description, but the deep source of these factor premiums, risk or mispricing, is still an open frontier for research.
This has been a phenomenal deep dive. Let's try and summarize the biggest takeaways. Two major things stand out from this research. First, maybe surprisingly, about half the anomalies people talk about.
Well, they might not actually be significant in the broad investable market.
Yeah, a lot of the claims seem exaggerated, likely due to that microcap focus in some studies. The anomaly zoo might be smaller than we thought.
And second, the empirical Q factor model, market, size, and those crucial investment and profitability factors, it just dramatically outperforms the older models like Fama, French, and Carhart in explaining the anomalies that are significant.
Absolutely. It provides a much more powerful and parsimonious lens. And the key insight is that many seemingly unrelated puzzles turn out to be just different facets of these two core economic drivers, investment and profitability.
It really highlights how crucial understanding those fundamental drivers is.
Yeah.
Even though the model is empirical, that link back to Q theory gives it such strong economic footing. But here's the final thought, the provocative question for you, our listener.
Given that this Q factor model works so well empirically, explaining so much, but it stays silent on whether it's risk or mispricing, what does that mean for you, for your investment decisions, your philosophy?
Yeah, does it ultimately matter why it works? As long as it helps predict returns based on measurable firm characteristics like investment and ROE? Or does the why fundamentally change how you think about risk and opportunity?
And where does research go next? Do we need to dig deeper into the structural sources beyond just factor loadings to truly grasp the underlying economic gears driving these persistent patterns?
Those are the big questions that keep the field moving forward. It's a fascinating journey into how markets really work.
Absolutely. Something to really chew on. This is knowledge that definitely goes beyond the headlines. Join us next time on The Deep Dive for another exploration of what truly matters.